Hey everybody, welcome to the live stream. Sorry, I'm running a little behind. Looks like I'm starting about 11 minutes late. I appreciate everybody who's joined and is ready to go. We've had a down market, so I thought it'd be interesting to kind of review where are the markets headed and see if this is the beginning of a trend or what the heck's going on. It was so nice to have 7 or 8 days of green, wasn't it? It was like, oh man, like the weather is nice and clear. You just enjoy nice cold iced tea in the backyard. And all of a sudden you get a storm and it starts hailing and you're like, what the heck? What happened to that nice weather? Well, it kind of feels a little bit like that, but we'll see. Maybe this is just one storm of negative numbers, and that's all we're going to see for this. But let's take a close look here. So we have the S&P down 0.89% over the last 5 days. And let's see here. We got Monday. We opened from Monday to this point. We're still in the green on the S&P, just slightly, but it looks like we're still holding on to a gain. Tomorrow will be the deciding factor to see if we're going to be in the green for the week or what's going to happen. The NASDAQ, it's a little more volatile. What did it do? So looking at the NASDAQ, it is down a tiny bit. No big deal. Down 0.1%. That's nothing. So really tomorrow is going to decide, is it going to be a green or a red week? If it's pretty much just a calm market, it's probably just going to be a push. The market's just going to push. The good news is that, stock prices are up. I know I've seen my portfolio really have nice gains. And what I didn't imagine, right, at the beginning of the month, the market just really went down, right? So the first couple of days in August, it was pretty red, man. I was like, holy smokes. The first 3 days of August, I think I lost like $80,000 in value. I'm like, oh man, it's going to be a brutal month. And it's not the first time, that you have these jagged falls. And then somewhere along the road, it started to kind of level off and I was back to even. Now I'm actually sitting on a gain, a modest gain, but I'm like, man, I was close to writing off August. I was close to saying, you know what? It's going to be a losing month. Oh, well, you can't win them all. The year's still good. But now if I can get out of August even, I'll consider that a win. We'll see what happens. But that's how the month started, and it kind of tempered my expectations a bit. All right, so before I move into looking at sectors, let me welcome everybody. Thanks so much for joining. Shadow Guy, hello, sir. Thanks for joining. Android PC, how's it going, man? Good to see you. David, good to see you, man. Thanks for joining. Didn't have technical difficulties. I'm just really busy, and I had a conversation that went a little long. I apologize. I had everybody waiting. I really appreciate you hanging in there. Mike, the dividend investor guy. Thank you, sir, for joining. Really appreciate all of you. Please, if there's a stock that you have in mind that you want to take a look at and see what the heck's going on with that stock, let me know. There's a couple of stocks that I want to look at, and I think it's an interesting market, and I'll review a couple of stocks in a minute. All right, so let's go into sectors. And I like to look at sectors because it kind of gives me a little bit of, what was moving up, what was moving down. And looks like today, the sector that did go up was real estate and financials. Real estate, I kind of understand. Financials, okay. Healthcare, right? I continue to see healthcare kind of play the right role, which is it didn't go down a whole lot yet. For the last month, it's doing okay. For year to date, it's doing good, especially if you are in the right healthcare companies. Eli Lilly being, the star of the show. The sector that went down the worst is technology. I think the semiconductors had a really bad day, Nvidia being the superstar semiconductor company in that space. So that went down quite a bit, but I wouldn't shed a tear for anybody who's invested in that space, especially if you've been there for a while, because you're making a lot of money. So that's interesting that technology went down, discretionary went down, consumer services went down, materials went down. Now, I keep hearing, on the, I guess, the radio waves and the information I read, there's a lot of concern around recession, and the data is supporting that we're probably going to hit a recession. But as I read the data and understand what's going on, I don't know if it's going to be a really ugly recession. It might just be kind of a slowing down, and you might technically experience a recession, but it's not going to be brutal. A couple of things that I look at as we kind of begin to understand, well, what's this recession look like? I have seen a lot of corporate job losses. Intel had job losses. It seems like a lot of these corporations are coming out saying, hey, we're going to lay off a lot of the corporate staff. And that's kind of a theme, I would say, that companies are beginning to use this opportunity to kind of, thin the amount of employees they have. They tend to base that on their forecast. If they're not going to grow and they actually see that certain markets are going to be tough and they're going to maybe decline a bit, they're going to let some people go. I mean, if they were like, hey, we're going to double in size, they wouldn't be like letting go of employees. So both the economic data is showing that, hey, unemployment's going up, job creation is slowing down. And once you have unemployment going up, it tends to go up really fast. It seems that businesses kind of lay off a lot of people at the same time. Then we have an unemployment problem. I think that's what's going to lead us into some kind of recession in 2025 or so. And that's just good to keep an eye on, because it's going to affect stocks, especially stocks that have more discretionary income-based kind of economies, retail, high-priced goods, those kinds of things. So just that stuff that I'm seeing and hearing. We'll see how it goes. But I thought I'd throw that out there. All right. So I thought today, I think I put it on the Discord that what was interesting is interest rates went down quite a bit. And when interest rates go down, and I should say that yields went up. I got it wrong. Sorry. That's when it's a good time to buy bonds. And I know bonds are super boring, but I'm into making money. And sometimes, making money in a boring, old-fashioned way is just fine. It spends the same, because when everybody else is loading up on stocks, stock market's just rallying, to the moon, everybody forgets about bonds. It might be a good time to buy when nobody's looking. And that's what I've been doing on bonds, is kind of just loading up my bond portfolio, loading up my bond ladder, so that if the market does hit a really bad, period of time, those bonds are going to look really pretty. They're going to be like, oh man, that thing makes 6-7%. What a beautiful concept a bond is. While some of my stocks are losing 20-30%, because that's what stocks do. If you look at 2022, Meta, which is an awesome company, it lost like 80% of its value. Nvidia lost 65% of its value. I can go down the list. Google, it lost 40-50% of its value. These are awesome companies, but even awesome companies lose a lot of value. So when it's almost like a contrarian kind of thought pattern is when everybody's loading up on one asset class, look at the asset classes that are being neglected, because you might get really good prices. So I've been, nibbling at bonds. I bought some bonds today. I'm glad I did so. All right, let's get into some companies. And it looks like the dividend investor guy wants to talk a little Airbnb and I think Humana. So let's jump into that. And let's start with Humana, because I could talk. You guys know I can talk about Airbnb for the next hour, but I'm not. Don't worry. Don't disconnect from this. And look at that. I've already got it on my brain. I said I was going to do Humana. All right, Humana. Humana is a healthcare payer. That's another way of saying is a health insurance company. Either individuals buy policies with Humana, or businesses or organizations buy insurance for their employees, and then they're covered by Humana. This was a beaten down stock. And if you look at their 5-year, it really came down in value. And the reason I know that is Humana was trying to merge with Cigna, and then that merger didn't happen. Now, their price went from, they were priced, at $500 a share, and then they went down as low as $300 a share. So that was a pretty good haircut. And now they rose nicely, and now they're back down. It's a $42 billion company. These guys have a niche. They have specialty insurance products. I think they carve out like the Medicaid services and kind of government sponsored kind of healthcare payer, which is different than a United Healthcare and an Elevance. Those guys are like big time. They insure big employers and individuals that want to buy their insurance, but mostly employers. And Humana has their niche. Now, as we look at these guys, their market cap's $42 billion, which is quite small compared to United Healthcare or Elevance. The revenue is really high, $112 billion of revenue. So you're buying the company at the revenue is 3 times what their market cap is, which is kind of upside down. It's supposed to be the other way around. That's why I had to think about it. The PE is 25. Forward PE is 20.9. Dividend is 1%. And it's a buy according to the analyst with a 7% discount. Now, last time I looked at this company, it's been a while, but it had negative. I think their cash flow wasn't looking all that great. Yeah, here we go. Negative cash. So first order of business on Humana is, why is there negative cash? What's going on with the cash flow? Because I value companies on cash flow. So what happened? Why is cash from operations negative? Well, there's a big a negative number of $7 billion change in unearned revenue. So it looks like they had this big accounting change. Okay, that's non-cash. So they had to reverse it. Then they had a ton of accounts receivable increase. So when accounts receivable increases, that means we don't have cash. We just have IOUs from our customers saying, yeah, we'll pay you, but you're going to have to wait a while. Whenever you reduce your accounts receivable, you generate more cash. So that's, I think, a big culprit of the negative cash flow is that accounts receivable number. Now, that could be a temporary a lag, but I just want to make sure it's not a problem. Why aren't they collecting on time? I would be curious to know that. What the heck's going on with their accounts receivable? We just need customers to pay us. Let's see, if we look at the quarterly, it did go down substantially. That's very good. So that's a very good sign that, hey, it was temporary. You see that big number there? But that was a quarter ago. In the current quarter, it went down. Okay, that's what I want to see. Now look at the cash from operations, $1.2 billion. I wanted to see that too. Okay, Humana, you're on the road to recovery. Very good. CapEx is nice and low. I love businesses that generate a lot of cash and only have a little bit of CapEx because they continue to build up cash on their balance sheet. They can buy back shares. They can grow their businesses. They can do all kinds of good stuff. If you have too much CapEx, it's almost like you're buying your business all over again every couple of years, which is a big drag. So very solid free cash. If we took this number, it'd be $1.1 billion of free cash flow for one quarter. Multiplied times 4, I'd get to about $4.4 billion of free cash flow. And they're only trading for $42 billion in market cap. This is a very valuable company that has been beaten up, left for dead, that's putting their business back together. Their cash flow looks good to me. These guys are probably discounted. Let's take a look at their revenue growth. Forgot that part. So the revenue is increasing. Man, what the heck? Why is their stock price down so much? The business is growing. That's very good. They're generating cash. We just proved that. They had some temporary kind of accounting, items. Maybe the AR was related to the whole, they were trying to merge with Cigna, and that created some delays and so forth. It definitely was disruptive. I think they do deserve a little bit of a haircut on their stock price because it was kind of a letdown. They were supposed to merge with Cigna. But I like their revenue growth. That's really solid revenue growth, double digit. So I like their revenue growth. I like their cash flow. Balance sheet. Let's make sure these guys aren't a mess when it comes to debt. So big debt problems can cause a business to go out of business. So right now they have $13.2 billion. Okay. Revenue wise, they're a very big revenue company. I compare debt to their EBITDA. EBITDA is earnings before interest, taxes, and depreciation. So we're going to go check out EBITDA, and I want it to be less than 3. EBITDA is 4.26. Okay. So their debt was $13.27. So they're right there at 3. You take 13 divided by 4.2, it's roughly 3. So these guys, their balance sheet is right there. It qualifies. I like to see the balance sheet, if you can be below 3, the further you are below 3, the stronger your balance sheet. Zoom, which had a very good day today, they have 0 debt and over $7 billion of cash. That's a really strong balance sheet. If you look at Google, strong balance sheet, more cash than they do debt. Apple, same thing. So these guys should work on their debt. Not sure why they're carrying so much debt, but it would be a good idea to get some of that debt reduced. So far, I'm liking what I'm seeing. So first, the company's generating free cash. The stock's been beat up. The stock's been sold off. This is an opportunity for somebody who believes in Humana, does their homework, and buys into a company that's beat up and kind of left for dead, because this stock could be worth, 50% more very quickly, like in the course of a year, 18 months, because it kind of gave up a lot of its value. And I don't know that the market really fairly discounted the stock the way it did. For a couple of years, they were well above $400 a share. So if the stock just went up to, let's say, $450, you'd be sitting on like a 25-30% gain on this stock. So I like what I'm seeing with Humana. Humana, to me, seems like a really good winning recipe. When we talk about desirable stocks, right? In this case here, we've got Humana, and insurance companies, they make, as I showed you, a lot of free cash, and this company's been growing. They have a very solid business that's very hard to replace. Once they get into these agreements with these government entities, very hard to replace them. So Humana, I'm not going to say is like a fully green. Oh man, these guys have awesome barriers of entry. They can never be replaced. But I would say they're kind of like partially green and mostly in the gray, but they're a solid business. And if you can get them at a discount, I think healthcare is going to do really well for the next year to 2 years. If we get hit with a recession, no worries. It's not like the people who are on Medicaid are going to say, oh, sorry, recession, I'm not going to go to the doctor, or I'm not going to go take care of myself. No, people actually will take care of themselves during recessions. They'll go to the doctor, take the medicines, especially if it's something that's sponsored by the government. I mean, what do they have to lose? In many cases, they're kind of getting it for free. So Humana looks good. I don't know what you think, Dividend Guy. I'd love to hear your opinion on it, but that's what I think. Let me see. Dividend Guy's got a couple comments. Let's see. Watch your bond. Okay, cool. Glad you like the bond dividend. You're buying Humana heavily right now. We agree, Dividend Guy. I agree with you. You agree with me. I think you're doing something that's wise there, and good luck with it. Now let's talk about Airbnb. Airbnb is what I consider is a special company. They didn't exist 15, 20 years ago, and then they created this home sharing platform, and it really has grown. Their revenue has grown really nicely. What's been somewhat confusing this earnings season, and it's not completely confusing, when you have a market where you have this upward trend, right? And really starting at the beginning of 2023, the NASDAQ's up 67%. So when you have a market that's this expensive, then the market may do weird things. Like Google announced their earnings, they were good, stock went down. Meta announced their earnings, they grew 20%, they have a massive business, stock went down. Microsoft, ditto. It's like, what the heck, man? It's like, which direction is this market going to price a stock? It's confusing, but it starts with, well, maybe the market thought stocks were too expensive and it sold them off. Okay, fine. I think Airbnb is being caught in that type of momentum of, yeah, we think Airbnb is great, but they're a new player. They're already a $73 billion market cap, and they were much higher. They've been selling off, as I'll show. They've sold off quite a bit. They've offered really good acquisition prices over the last couple of years. So I'm sitting on a gain, a small gain, but a gain. And I think it's really set. What I like about Airbnb, I'm gonna do this reverse because this one does deserve to be reversed. Airbnb is very hard to replace. There's one Airbnb, and I think their competitors would yell as loud as they could that, oh no, we do the same things and da 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 da. But you know where it counts is users. You know where it counts is customers. Airbnb continues to grow much faster than any of their competitors, and they keep taking market share away from their competitors. So you could rationally say, well, Airbnb does the same thing as Booking. They do the same thing as VRBO, and they do the same thing as Flipkey and on and on. Yes, but like I could use that example across all different businesses. Costco is a retailer. So is Macy's. So why is Costco worth almost 400 billion and Macy's is worth like 10 billion? It's because Costco does what they do far better than anybody else. They just keep growing their market share and taking away share. Airbnb is similar to that. They're so good, they just keep growing. And they're good because they understand this market and have taken a brand new expanding market that is very large and continues to get bigger. It's a global business now that they're growing around the world. It just has so many advantages. So I put Airbnb in the green. And some people might argue, but they have competitors. Absolutely. Google search has competitors, but Google search dominates. And so does Meta. Meta has competitors. They have Snapchat to deal with, and they've got TikTok to deal with. But Meta dominates. They're a market share leader. And Airbnb, I believe, is in that same category. Is they dominate home sharing. And they're not going to dabble into other things that just to make themselves bigger in the wrong ways. They organically grow. They're getting more homes on their platform. They're getting people that are either customers, rent more often, rent bigger properties, more expensive properties, all kinds of good stuff going on. So having said that, when I look at an Airbnb and I look at, a sign of a business being strong is growth. Very good growth numbers. And when we go quarterly, I think the quarterly numbers, 10% growth in a travel industry. And they guided that number, by the way. They said, hey, we're going to have a lower quarter, but now we're going to kill it in Q3. They guided that Q1. So don't forget that. Airbnb said that Q2 is going to be light. They said that more than 3 months ago. But look out, because Q3, we're going to kill it. Because we're having the Olympics in France, and I believe Airbnb housed 400,000 travelers in France for the Olympics. 400,000. Now, that's not 400,000 units that were rented. I'm sure there was like a unit or something. That's still a big bump that I expect in their earnings. So I've been buying shares of Airbnb because I think their Q3 number is really going to impress, because they said that. They said that 3 months ago. Now, the stock market doesn't have a great memory, I guess, and investors don't have a great memory either, but I do. And I remember seeing that on their earnings for Q1. So Airbnb has good growth rate. They're very unique. I really like their business. It's an expanding market. They have great barriers of entry. So all that looks great. And what makes them super special is cash flow. It's one thing to be a cool business that's growing, But when you grow and generate cash flow, you become valuable, because that cash, that's what makes Apple so valuable. Microsoft, Google, Amazon, those companies create cash. And when you generate cash, you can buy back shares. You make your balance sheet stronger. You acquire other businesses. You become more valuable. So these guys are growing. They have an awesome model. They're in an expanding market, and they have cash, and they're generating cash for a young company at early in their history to generate cash. Now, let's look at debt. What kind of debt we got here? Airbnb, $2.2 billion of debt. All right. So you got $11.2 billion of cash. They can write a check. It'd be a big check. Maybe not enough room in there to go $2 billion. I guess they'd have to do electronic, or maybe Venmo that amount. And they could pay that immediately. So they really don't have debt. If you deduct the debt from the cash, they have about $9 billion of useful cash to buy back shares, acquire companies, make their business stronger, come up with a new idea and a new product line that fits their model. So I like Airbnb. It's one of my bigger holdings. I have invested substantially in Airbnb because I believe that they're going to be one of the big valuable companies on earth. I believe they're up here in travel. I've invested $87,000 in Airbnb stock, and it's worth $90,000. So I've got a small gain. It's gone up and down as I showed the chart, and I continue to buy shares in Airbnb and feel like that company is going to double in value every 3 years. For sure, I feel that way for the next 3 years, and then we'll see what happens. Tune in 3 years from now, and I'll tell you what I think is going to happen with Airbnb. So thanks, Dividend Investor Guy, for asking about Airbnb. And those are my comments on that. Let's move on. Falls Grave. Hello, sir. What sector is usually good in recession? Oh, man, let's talk. Let's talk about recessions. Recessions, okay. So investors should be, you've heard the term, give me a second here. Let me think for a moment. You've heard the term contrarian. You think the opposite. Like everybody says, hey, we think this is going to be the best play, and everybody invests in it, drives up the price. Well, the contrarians are looking at the opposite and saying, well, what would be the opposite effect? So it takes a little bit of contrarian thought of when the economy slows down, what's going to really pop up. Healthcare is good in recessions. Consumer staples are good in recessions. Now, the thing I want to keep an eye on is I would rather put my money in a bond that pays me 4%, 6%, 7% if I'm lucky, instead of having very poor returns on stocks. Because if I buy a consumer staple stock and maybe my timing wasn't perfect and I got in at the wrong time and then sold it at the wrong time and I lose 20% on a stock, well, that sucks. And overall, over 5-year history, consumer staples don't do very well. But healthcare, they do very well over a longevity. So you can sit on a healthcare stock, and I think buying into healthcare right now is a good idea. And you can kind of double, triple your money over the course of 5 years. So I like that. So consumer staples, be careful. You got to get in and out correctly. I think healthcare has a longer run of appreciation. Technology tends to suffer, especially the wrong parts of technology that are very consumer-based. They get hammered. Some parts of financials go down, some parts go up. Consumer financing goes down. Things that are non-necessities, non-essential go down. Industrials, now industrials is kind of a combo. Early in a recession, it's very bad. In the middle of the recession, it's great to buy it because you'll get it discounted. And then as we grow out of that recession, industrials catch fire. Consumer discretionary, I would say, is bad for recessions. Materials is the same thing as industrials. If you got to keep your eye on these two as we head into recession, because it's almost like, the prices are going to be perfect and the timing's going to be right to buy them in the middle of the recession. And then as the news starts to shift from we're in recession to we're getting out of recession, those sectors tend to rally. And then real estate doesn't do very well over longevity, like REITs. They're usually based on income for dividend investors. So I'm not buying a lot of real estate, especially going into recession. Consumers, communication services, I think is good going into the recession, getting out of the recession. We're not going to stop getting on, Facebook apps. We're not going to stop using Google search. We're not going to stop using, YouTube. They may see kind of like their revenue grow a little bit slower, but they're still really profitable. So those are still good. Energy, it's okay. It just doesn't do great over longevity. So that's some comments on what industries are good and bad. I would say that, going into the recession, healthcare is solid. That'd be like my number one. And from there, communication services could be solid, buying into the right companies. Then after that, I would say be ready to pick out the right financials that are good, like big banks. And at the right time, look at industrials and materials, which you can make a lot of money as you grow out of that recession. So thanks for the question. All right. 3 days ago, Android PC. 3 days ago, Nicola was making noise, big fuss about their H truck. Let's do it. This company has been beat up, right? And they kind of, caused it on themselves, so to speak. Now they were rocking. Oh my God. Oh man, I got to see this on Google Charts. So this might be the worst situation that I've ever seen. So they were here. I don't know what that was, a short squeeze. Now the market said, we're going to sell these guys off 50, like half a cent on the dollar. These guys are so bad, they're pretty much worthless. Well, let's see if that's true. Worthless means that, not even like the furniture, the office furniture could be resold on Craigslist or eBay. It means, man, you should at least have some kind of salvage value for the IP that they created, because these guys are doing electric big trucks. All right, so revenue. So revenue is low. 48 million isn't very much. They're supposed to be doing big trucks, and those big trucks are expensive. They're like $300,000, $400,000 per unit. So that's kind of concerning that they're that low in revenue. They are not profitable. Okay. Understood. How much cash do they have? They have $258 million of cash. Okay. See how their cash position is going down. 466, and now it's down to 258. That's a concern. All right. Cash flow. So cash flow is, they're burning cash fast. Oh, man. This is a bad situation. You're burning $522 million of cash. You don't have a lot of cash on the balance sheet. You only have like half a year's worth of cash on the balance sheet. You're losing money on your revenue. Your revenue is not growing. Not good. Not good. I don't know if these guys are going to make it. This is going to be one of the stocks. If somebody were to come in and save them like a white knight, their stock is going to scream up to, I don't know, $20 a share. But I would guess that these guys are not going to exist in the future. These guys are going to, it's just the numbers are like, hey, they just have way too much. They burn too much cash. They don't have a big footprint. I mean, their big competitor, right? Tesla builds trucks, these big trucks that are EV powered. And I think those trucks are going to be needed, because when we look at, the conditions, like I live in Los Angeles, we have two major ports here locally, And the big, diesel burning trucks, they're pretty dirty and they pollute the cities. And I think the cities are fed up with it and they want electric trucks to move through their cities. And I think LA, I'm in California, so we tend to care about the environment. I think they're going to be forced to use EVs. So the market is somewhat fertile for these kinds of products, but these guys, I know their founder was kind of sketchy and kind of, misrepresented a lot of things. He's been kicked out of the company. So I think that was part of the recipe for failure, and other companies might do better. The company I'm thinking of that I'm kind of have my fingers crossed will do well is Rivian. That's similar to that. And the reason I like Rivian is it, how do you spell Rivian? Is it Rivian? So I like Rivian more because they have that they're partially owned by Amazon, and they have a contract to sell all their production of those electric vans to Amazon. That's a huge advantage. They do consumer products, like they do really nice trucks, but they're like $100,000. And I mean, geez, that's a lot of money for a car. And they have these SUVs that are like $100,000. They are pretty popular, and they do compete against, like Land Rovers and stuff like that. I see a lot of those cars driving around here, but I'm in Southern California, and Rivian is actually headquartered in Irvine, California, which is 10 miles away from where I live. So, Nikolai, I just don't know what's going to happen to them, but I would venture to guess that they're probably not going to exist. Thanks for the question on that. Nighthawk, hello. I read someone talking about IEP changing the way they're going to manage cash flow to hopefully bring their stock price up. Plus, they offer a crazy dividend. IEP. Okay, Icon Enterprises. So Carl Icon's had a lot of trouble. I think he's had some legal issues. So these guys are a subsidiary, engages investment, energy, automotive. These guys are a little bit like Berkshire Hathaway, right? Carl Icahn, I believe, runs this company, right? Am I thinking of the wrong company? These guys are oil and gas. Icon Enterprises, LP. Icon Enterprises, investment, energy, automotive, food packaging. See, it's like a conglomerate. Maybe Carl Icahn got kicked out of it. So this is this guy, and I believe he started Icon Enterprises. Here it is, Icon Enterprises. All right. But he has had a lot of legal problems. I think he was kicked out of his own company. He's 88, so I'm sure he's fine. He probably has billions of dollars and so forth. Now, these guys are, for the 1 year, down 17.8%. I know that the Icon name is kind of being dragged through the mud, and Carl Icahn's had plenty of problems. So they're a low cap company. Revenue is more than their market cap. PE ratio not available. They're losing money. Forward P is 21. Okay. All right. So when we look at their revenue, the revenue has been going down for 2 years. It went down 19 and 20. Okay. That's not a bad trend, right? Losing money, grew, and then losing revenue. Okay. So I think in the most current year, they're probably losing money. Losing money. That's why they didn't have PE. And if we look at their cash flow, free cash flow is doing quite well. So you have $2 billion of free cash flow. Let's look at the quarterly because that'll give me a more precise, is the cash flow moving up or down? So net cash flow is positive in the most recent quarter. That's good. All right. So I'll take that $2 billion. This business is undervalued. This business is being heavily discounted. It was a $70 share. Now it's 15. That's a huge haircut based on cash flow. But let's look at balance sheet because they may have too much debt. Debt level, total debt, 7.1 billion. All right. And how much cash? 2 billion of cash, not bad. Now, when we look at EBITDA, they have 400 million of EBITDA. So they do have a lot of cash. So the revenue is 10 billion. EBITDA is only 437, which is a very low EBITDA number. Let me look at something really quick. I'm going to look at historically what their EBITDA number is and see if it's been higher in the past. Yeah, it was much higher it was higher here, lower here. So I don't like the balance sheet here. The balance sheet's like net debt's 5 billion. It would take them roughly 12, 13 years to pay off their debt if they had to operate the business and use EBITDA to pay off debt. That's too long. That's an unhealthy balance sheet. Maybe that's why the stock's being sold off so much. Remember that a business could be a good business. If they have too much debt, they are a slave to their debt. They will just work to pay off debt, and they will not work to reward stockholders. And they run the risk of being bankrupt. So too much debt on Icon Enterprises. I would not touch this. I would not deal with it. It looks like all the short sellers came in and shorted the stock, so they probably have a lot of short sellers on it. I'm surprised that it's not. Well, the price is so low now, all the shorts already made their money. So I would not touch this stock. Thanks for asking. It was interesting. I haven't looked at that stock really, period, but I have heard the bad news around Icon. All right, Falls Grave. What's going on with GE? So GE broke up. So the GE we knew 10 years ago ended up becoming 3 parts. There was a part that went into aerospace, which I believe kept the GE symbol. They do the engines on airplanes. You may see them on an airplane that you're seated in. And then there was a GE healthcare piece. Then there was another piece. Was it GE Capital? I forgot what the third business was. One was healthcare, aerospace, and there was another one. The 3 parts have been doing well. I think the breakup was good. Look at this guy. Woohoo! Rock and roll, baby. 90%. That's what I'm talking about. So we came out of COVID. Jets needed more engines. They sold a lot of engines to build capacity for the airlines, and that's how they made such an appreciation. They're $184 billion market cap, and their PE is high at 40, 37. Now, the airlines are like at capacity. They can't sell any more seats. And I'm not optimistic that the market's going to be great for airplanes for these guys. I think the volumes are going to come down. The revenue has been growing, and they grew quite a bit for the trailing 12 months. But for 23, they grew at 17%. They used to be bigger. You see 87, and now they're at 65 trailing 12 months. Now they are there. Here's a restructuring charges where when they had the divestiture, they split into 3 parts. I think that's part of it. Okay, so they are profitable, very good profit. Okay. And free cash flow. All right. So free cash flow, 3.5 billion, 5.1 billion. So for a business like this, I would go like 5.1 times 15 would be the best I can do. And that would get me to like 80 billion. And these guys are being priced at 184 billion. I would not touch this stock because they're in a business where, it's once you've hit your full capacity, it's very hard to grow. This is an industrial, it's aerospace. They're making these big turbines for airplanes, commercial and defense. And this market tends to grow real slow. It's not like, oh man, they doubled in size or revenue. So this one seems quite a bit overpriced to me. They're up 90%. Not a giant surprise. Their stock was trading at $60 a share. Now it's $160 a share. So the money's been made on GE is my observation. It's a solid historic company, but it's not the right stock for me. I don't know who would say it's a strong buy. I guess somebody who wants to lose money. All right. So thanks for asking, Fallsgrave. All right. So we talked about Humana. Very smart guy. All right. Do you have any thoughts on NE stock? NE. Noble. So we looked at this stock. So they're an offshore drilling company. Okay. So they do contract work. They're kind of call it a construction-like company where they drill for oil companies. They've been around a long time, since 1921, so 100 years. Financials, they are growing nicely. Now look at the quarterly. The revenue is growing in the quarter. Looks good. Okay. Now oil prices were going up. Now they've come down. So you can see how as oil prices have come down, and I'm looking at the day, so you can't really see that, but you can see it here. For the 1 year, down 21%. As oil prices come down, the prospects to drill more go down because they're like, hey, why do we want to pump out more oil? The price isn't very good per barrel. So it's going to be pegged on oil. And having said that, these guys are a $5 billion company. Over the last year, they're down 27%. Over the last 5 years, they've done okay, 48. It's been a little bit of up and down. When oil prices were nice and high or higher, looks like their valuation was higher. So we looked at earnings growth, but cash flow wise, how are they doing with cash flow? Not a lot of cash flow. Based on 113 million of cash flow, the best I can do from a valuation standpoint is like 2 billion, maybe 2.5 billion. They're being they have a market cap of 5 billion. So it's not a very stable business because you can have the ups and downs of oil. It's very small, so it's risky. And I think it's somewhat overpriced just based on the free cash flow that I'm seeing. I haven't even looked at their balance sheet. So it's not the right company for me. I just think it's too much risk for not a lot of payoff. So thanks for asking. Yeah, so just went over Noble. And I had gone over this stock, I'm going to say 2 weeks ago. And I think I came to the same conclusion. Yep. Got to you, very smart guy. Hopefully you found my comments interesting. Mr. 123 Cheetah, are you buying any banks? I own Citigroup, and I've been buying more Citigroup. I think that the big banks, and now I'm going to be politically incorrect. So big banks, right? They're too big to fail. So when you have these big banks, they have the safety net of the federal government, Citigroup, Chase, Wells Fargo, Bank of America. And they don't come out and say it, but the reality is they're just too big to fail. And they're very diversified. And it seems like they make money in a variety of ways. Citigroup, to me, provides the best value proposition, and it's been a good stock. It's done well. Other banks look pretty good. I know Warren Buffett got big into banks. He's big Bank of America shareholder. He's been selling shares of Bank of America. I don't know what that means, but Wells Fargo is a good bank. Smaller banks like US Bank look really interesting to me. I owned it for a while and then I sold it. So I do like banks. I have one bank. That's all I need. And I like that it's appreciated nicely and I can make money from that one stock out of that industry. So Nikola scam. Yeah. That company just had so much bad press and it lost a lot of confidence from their industry, stockholders, everybody. Yeah. So I talked to you about NE, they're an oil driller and, the oil drillers, these guys, Halliburton, Schlumberger, which does a lot of services for oil, they have good runs. Like if you are good at understanding oil, like you think, oil prices are going to go up 30%, then buy these oil drillers because they're going to go up fast. But if you're not that good, then I don't know. I would pick industries that you're going to really be able to manage well. Oil, you got to get in and get it out. For an oil driller like this, you got to know when to buy, when to sell, when's a good acquisition price. You see oil prices coming, going up, and then you have an exit strategy. So those are my comments there. All right, I got 5 minutes to go, guys. So just a fair warning. Quags, I'm not a fan of REITs, correct? Apartments are an exception. I do like REITs around apartments. They just tend to be really high priced. There's a couple of REITs that do apartments, and I think they call it multifamily. They're just making a lot of money because the housing is in such high demand. They can raise their rents and they make lots of money. But I control my investment with REITs. I own properties and I rent them out to people. So I do that, direct. I own the properties and I rent them out. So to me, it feels a little like I'm violating my, the principle of diversification. If I own an apartment REIT and I own units that I rent out to people, it's like, dude, you're already doing it. Why are you buying a REIT? So, but I think it's a good idea. There we go. Rivian. Rivian. So these guys are interesting. At one time, this was the second most valuable car company on the planet. And I think they had shipped out like 50 cars at that point. Isn't that nuts? Just totally nuts. But that's the stock market for you, man. Sometimes the stock market is absolutely nuts. Here we go. They IPO'd $129 a share. Now they are being sold for 10% of their original value. So when they IPO'd, they were basically 10 times this number. They were $130 billion market cap, made them the second most valuable car company on the planet. And they had shipped out like 50 units. Nuts. But that's the market. All right. So their revenue is $5 billion. Impressive. If we look at their growth, look at this growth. Beautiful. Man, look at that. Now they are not making money. Not the end of the world. It's a young company. They are burning cash. Man, burning a lot of cash. What the heck? Are you at least slowing down? Slowing down the cash burn? Let's take a look. All right. They are slowing down their cash burn. Very good. So they're only burning $1 billion of cash a quarter. So at some point, they will be cash positive. Now, what I do like about this business is they're more commercial. That's where the money's at for them. They make those electric vans, and Amazon pretty much buys all of them. And Amazon's gigantic. I don't know when they're going to stop buying them, but I see them everywhere here in Southern California. This is an interesting company to follow. I'm not ready to invest in them. They don't create free cash flow. It's all, looking at the company and kind of doing projections that are big part of it is imagination and not true valuation. Like you've seen my valuations where I go cash flow and I do net present values. Well, here it's complete imagination. I'm not ready to do that because it's automotive. Automotive is tough, man. You've got parts, manufacturing, employees, liability, lawsuits. I mean, it's just a really tough business. Now, I'm rooting for Rivian because I think it's a really good idea to have these electric vans to deliver packages. But that's the company I was thinking of when Nikolai came up. All right, so thanks for the tip on Rivian. Appreciate it. Yep, you're welcome on that. Hindenburg report. Oh, man, Hindenburg. Dude, Hindenburg. I mean, that's kind of like when that dude comes knocking, it's bad news. And one of these days, Hindenburg's going to be like called out and they're going to be wrong. But we'll see. All right, so Snow went down. I don't have time to review it. I think Snow is having a lot of trouble because their software has some flaws, some security flaws. Their customers have been hacked a few times, and I think that word is getting out to the street. That's going to be a big issue for them. Know that their revenue was growing, but their stock, I think, dropped 13%. I'd love to do more. I think I'm going to do a video on snow because that was a really interesting. I wrote it down. I was going to cover it on the live stream, but I've run out of time, guys. I got to get boogieing and do something else. I apologize, but I had a lot of subscribers today. Awesome. Thanks so much for joining. I'm going to try to go real quick here. BYDDY. I don't have time. I'm sorry. And then we've got Real Estate Guy. Great to see you. Bad Omen. Very nice to see you. I'm sorry I can't cover that. And then JS Yao, Real Estate Sales Rep. I remember you joining. Very nice to join again. And if you want to go to the Discord or just go to the channel and shoot me a message, I'll provide some comments over messages. I'm still shorting Nvidia. I'm thinking through what I'm going to do ahead of those earnings. A week ago, I was thinking, okay, I think I'm going to I'm going to close out the position, which is buy shares and then close the short position before the earnings, because who knows what's going to happen. We'll see what happens. The earnings will be after the market closes on the 28th. So it's next week. We'll see. It's going to be a decision I'll make early next week, and we'll go from there. Visa, MasterCard, solid companies. I think in general, they're overpriced, but they're solid companies. I like within that space, that universe, I really like PayPal. PayPal is beginning to work, and I think it has a lot of room to run. Visa's priced for perfection, and frankly, it deserves it. It's a very good company. MasterCard is the same. But if something changes in that industry where they start losing market share, that valuation falls apart and Visa will be worth less. So that's my general comment on Visa and MasterCard. Thanks, Dividend Investor Guy. Thank you. Louis Vuitton. Maybe next time. You guys, if you want to get on the Discord, go to the channel. You can tune into the Discord. We can, communicate that way. Today I had about a solid hour to go, and I've got to that hour. These down markets I know can be frustrating. Everybody just understand that down markets are an opportunity. I know I bought shares today because some certain stocks really came down, and I went on a little buying spree and bought some shares, especially of Amazon. I bought another $1,000 of shares for Amazon, and these down days are not total bad news. It's a good time to buy. We'll see if these sell-offs continue. I'll be very curious to see what happens tomorrow. If we see another downturn, it might be the beginning of another down kind of period like we saw about a month ago, because this might be kind of there was a sell-off followed by a rally, and then it was a relief rally. Boom. And it's going to sell off again. We'll see. We'll see. If some bad news hits, that's possible, but hopefully we smooth out from here. Everybody, have a good night. Thanks for tuning in. Really appreciate your support. Good luck investing.